You have a trading plan. You wrote it out. You know your setups. You know your entry conditions. You know your risk parameters. The plan is clear. And then the market opens, and something happens that wasn't in the plan. A move you didn't anticipate, a setup that looks similar but isn't quite right. A feeling that this is the trade, even though the checklist isn't complete. And you take it anyway. If that happens regularly, this video is going to explain why, and why it feels like skill every single time it happens. The improvisation trap is the most socially acceptable pattern in trading psychology, because improvisation in the moment sounds like experience. It sounds like reading the market. It sounds like the kind of intuition that separates advanced traders from beginners. For the vast majority of retail traders, it is none of those things. Genuine trading intuition, the kind that actually works, is pattern recognition built from thousands of hours of deliberate study and consistent execution. It is extremely rare. It develops over years, and it almost never feels like a gut feeling in a retail trader with less than 5 years of experience. What feels like intuition in most cases is something else entirely. It is the brain finding justifications for a decision that was already made emotionally and presenting those justifications as logic after the fact. Here is how the improvisation trap actually operates. A trader sits at their desk with a plan. They know exactly what they are looking for. They have defined entry conditions. They are waiting. The market moves. Something catches their eye. It is not their setup, but it looks interesting. Price is moving fast. There is momentum. There is urgency. And the brain does something very specific in that moment. It does not evaluate the situation against the plan. It finds reasons why this situation is an exception to the plan, why this particular move is different, why the normal rules do not quite apply here. That process, finding reasons why the current situation justifies breaking the plan, is the improvisation trap activating. And it happens in seconds, before conscious evaluation can catch it. There is a second version of this trap that is even harder to catch. The setup is technically valid. All the entry conditions are met. But something in the execution deviates from the plan. The position size is slightly larger because the move looks so clean. The stop is placed slightly differently because this particular structure feels like it needs more room. The target is moved because the momentum suggests it could go further. The entry was planned. The execution was improvised. And the outcome is determined by the execution, not the entry. This version of the improvisation trap is particularly dangerous because the trader genuinely believes they followed their plan. They took the right setup, they just made a few small adjustments. And those adjustments, compounded across hundreds of trades, are the difference between a profitable system and a losing one. Let me show you exactly how this plays out in a real session. A trader has a clear plan. They are looking for a specific pattern at a specific level with a specific risk-reward ratio. They sit down. They wait. 30 minutes in, a different pattern forms. Not their setup. But price is moving fast. There is volume. There is energy. Their plan does not cover this situation. But missing a move feels worse than taking an unplanned trade. So they take it. And they frame it as reading the market, being adaptable, not being rigid. The trade loses. They exit. Their planned setup forms 20 minutes later, exactly as they anticipated. They are not in it. They used their risk on the unplanned trade. The day ends with a loss on an unplanned trade and a missed profit on a planned one. The improvisation trap did not just cost them the loss, it cost them the opportunity.
Here is the part that makes this pattern so persistent. Sometimes the improvised trade works. Sometimes it works better than the planned trade would have. And when that happens, the brain records it as evidence that improvisation is a valid approach, that being flexible is a strength, that the plan is just a guideline. Plans are not guidelines. Guidelines are guidelines. A trading plan is a decision made in a calm, rational state, before the market opened, before the money was at risk, before the emotional pressure of a live position activated. A decision made in that calm state is almost always better than a decision made in the heat of a live market. Not because the plan is perfect, because the conditions under which it was made were better than the conditions under which you are now trying to override it. What do traders who have broken the improvisation trap do differently? First, they write their plan at a level of specificity that removes discretion. Not, I will look for momentum setups at key levels, but I will enter when price closes above this specific level on this specific time frame with volume above this specific threshold and risk exactly this amount with my stop here and my target there. The more specific the plan, the harder it is to improvise around it. Vague plans invite interpretation. Specific plans invite execution. Second, they treat every deviation from the plan as data, not as flexibility, not as adaptability, as a deviation that needs to be logged and reviewed. If the deviation was profitable, it goes in the log. If it was a loss, it goes in the log. Over time, the data answers the question definitively. Does your improvisation add value or destroy it? For most traders who actually track this, the answer is clear within 30 days. Improvised trades underperform planned trades consistently. The data removes the argument. Third, they implement a simple pre-trade checklist. Before entering any position, 5 questions. Is this setup in my plan? Does it meet all entry conditions? Is the position size correct? Is the stop placed according to the plan? Is the target defined? If the answer to any of those questions is no, the trade does not happen. The checklist is not about being mechanical. It is about catching the moment when the improvisation trap is trying to activate and giving your rational mind one last chance to override it before the position opens. One important distinction before we close. Adapting your plan based on new information is not improvisation. If the market structure changes significantly, if a key level breaks, if volatility expands beyond your parameters, if a news event changes the context, adjusting your approach based on that new information is sound trade management. The distinction is simple. Adaptation responds to new market information. Improvisation responds to emotion, to FOMO, to boredom, to the feeling that you are missing something, to the belief that this particular moment is an exception. New information justifies adaptation. Emotion never justifies deviation from the plan. This video is for educational purposes only. Nothing here constitutes financial advice. Trading involves substantial risk and is not suitable for everyone. The question I want you to sit with after this video: if you tracked every unplanned trade you took in the last 3 months, what would that data tell you? Most traders who answer that question honestly already know what the data would show. The question is whether they are willing to look at it. Drop your answer in the comments. And if you have not seen the previous videos in this series, watch those next. Each one covers a different pattern that destroys execution even when strategy is sound.